Ford recently disclosed its fourth quarter financial results, and to everyone's surprise, the figures fell significantly short of analysts' predictions. Despite the buzz surrounding the release of the Ford Lightning electric vehicle, the company reported substantial losses in 2022. Looking ahead, the forecast for 2023 indicates even more significant financial challenges. The venerable Ford Motor Company, with a rich 120-year history, is an iconic player in the American automotive industry. Under the stewardship of CEO Jim Farley, the company has undergone a substantial restructuring aimed at navigating the evolving automotive landscape and tapping into the booming market for electric vehicles, EVs. In a bold move, Farley decided to separate Ford's EV business from its traditional gas and diesel engine segments. This restructuring led to the creation of three distinct divisions, or pillars. The first among them is Ford Model e, a division singularly focused on the development and sale of electric vehicles. This strategic shift reflects Ford's commitment to addressing the burgeoning demand for EVs in the market. Car market. The second pillar, Ford Blue, encapsulates the company's commitment to traditional internal combustion engine, ICE, vehicles. This division continues to serve customers who prefer gas or diesel-powered cars and trucks, offering a diverse range of options to meet their specific needs. In doing so, Ford ensures that it caters to a broad spectrum of consumers with varying preferences in the rapidly evolving automotive landscape. Lastly, there's Ford Pro, the commercial vehicle division, which extends its offerings to both the commercial and industrial sectors. This division presents a varied lineup of vehicles designed to meet the specific demands of businesses and fleet operators. Ford Pro strategically sells a mix of combustion engine vehicles and electric vehicles, aligning with the diverse requirements of its commercial clientele. In a departure from its past reporting practices, Ford has shifted its focus from regional profit reporting to a more granular approach. Now, the company reports profits separately for each of its three business divisions. This change in reporting aims to spotlight the performance and growth potential of Ford's EV business, offering a clearer and more detailed picture of its success in the expanding battery-powered car market. Expertise embedded in Ford's long-standing manufacturing capabilities. This strategic decision was not without its fair share of controversy, especially considering the diverse opinions circulating on Wall Street regarding the future trajectory of Ford's EV business. Some analysts urged Ford to take a different route, proposing the spin-off of its EV unit into a separate entity solely dedicated to electric vehicles. This approach, they argued, could potentially unlock additional value and streamline the focus on the rapidly evolving EV market. However, CEO Jim Farley and other top executives at Ford held a divergent view, opting to retain the EV business within the company. Their rationale centered around the conviction that keeping the EV unit in-house would allow Ford to harness its well-established manufacturing expertise and infrastructure. The foundation laid by the existing Ford Blue and Ford Pro divisions offered a solid base to build upon. By doing so, Ford aimed to capitalize on its already established resources and operational capabilities, providing a competitive edge over EV startups compelled to construct manufacturing facilities from the ground up. The underlying logic behind this strategic choice was to sidestep redundancy, steering clear of duplicating efforts and incurring additional expenses. By leveraging the existing strengths of the company, Ford sought to maximize efficiency and enhance its position in the burgeoning EV market, drawing upon the wealth of knowledge and experience ingrained in its extensive manufacturing history. $1 billion for the entire year. However, despite the production capabilities that Ford had meticulously developed over its extensive tenure in the automotive industry, the strategic decision to retain the EV business in-house faced unexpected hurdles. Contrary to the initially anticipated explosive start, Ford Model e, the company's electric vehicle business, encountered formidable challenges. The year preceding this revelation marked a significant setback, with Ford reporting a substantial operating loss of $2.1 billion in its electric vehicle segment. This figure fell notably short by $1.1 billion compared to the company's own full-year guidance and failed to meet the income expectations set by Wall Street. Ford attributed these disappointing results to execution issues that plagued its operations. Despite generating a substantial revenue of $44 billion in the fourth quarter of the year, contributing to a total annual revenue of $158 billion, the financial performance of the EV business fell far below expectations. The intricacies of execution challenges played a pivotal role in this setback, prompting Ford to reassess its strategies and operations in the fiercely competitive electric vehicle market. A net income of $1.3 billion for the entire year of 2022. However, the financial landscape presented a nuanced picture, as the company reported a net loss of $2 billion in adjusted earnings before interest and tax. EBIT stood at $2.6 billion for the fourth quarter and $10.4 billion for the full year. These underwhelming financial results prompted CEO Jim Farley to openly express his frustration with the company's performance. Farley acknowledged that Ford's potential for the year was far greater than the realized outcomes and underscored his disappointment at leaving approximately $2 billion in profits on the table, profits that, in his view, were within Ford's control. Addressing the situation, Farley emphasized the imperative for enhanced execution and improved performance to rectify the financial setbacks and ensure better results in the future. In candid remarks, Farley stated, "I'm frustrated is an understatement because the year could have been so much more for us at Ford." He went on to remark, "We should have done much better last year. We left about $2 billion in profits on the table that were within our control, and we're going to correct that with efforts before reaping long-term rewards." The company's projection for a substantial loss of $3 billion in the Model E segment for the full year of 2023 underscores the challenging path that lies ahead for Ford in achieving profitability with its electric cars. Ford's chief financial officer, John Lawler, shed light on the anticipated losses during a call with reporters. He rationalized the forecasted financial shortfall by framing the Model E segment as akin to an electric vehicle startup within the larger Ford entity. Lawler's explanation draws attention to the shared reality that, much like other electric vehicle startups, Ford is currently navigating a phase of substantial investment. In alignment with the broader industry trend, the company's focus is on building essential capabilities, cultivating expertise in electric vehicle technology, scaling up production volumes, and capturing a significant share of the market. Lawler's comparison to electric vehicle startups experiencing losses in their initial stages reflects the understanding that the electric vehicle sector demands substantial upfront investments and concerted efforts before realizing sustained profitability. The projected losses in the Model E segment underscore Ford's unwavering commitment to investing in research and development efforts, emphasizing the company's dedication to establishing a formidable presence in the rapidly expanding electric vehicle market. Despite the current financial challenges, Ford has set ambitious goals for its Model E segment. The company anticipates the Model E segment to achieve operating profit margins of around 8% by 2026, aligning with Ford's broader target of achieving a 10% overall profitability within the same time frame. To realize this ambitious profitability goal, Ford's strategy hinges heavily on a substantial increase in production. Ford envisions a significant expansion of its manufacturing capabilities, aiming to build 2 million electric vehicles annually by the end of 2026. This production ramp-up serves as a critical component of the company's overarching strategy to not only offset current losses but also to position itself as a major player in the evolving landscape of electric vehicles, demonstrating Ford's determination to capitalize on the growing demand for sustainable transportation. The ambitious production targets set by Ford represent a substantial leap from the company's 2023 goal, where it plans to produce 600,000 electric vehicles. The projected increase in production volume stands out as a pivotal driver for Ford's ambitious profitability targets. Ford's strategy revolves around scaling up its electric vehicle production, with the aim of reaping the benefits of economies of scale, improved cost efficiencies, and expanded market penetration. This strategic approach instills confidence in the company's ability to achieve higher profit margins within the Model E segment and overall. Scaling up production emerges as a critical factor in realizing profitability for Ford's electric vehicles. By significantly increasing the volume of electric vehicle production, Ford positions itself to capitalize on economies of scale, leading to substantial cost savings and improved profit margins. According to Ford's teach-in presentation, the Model E segment currently operates at an approximate margin of 40%. However, the company acknowledges that a significant portion of this margin is expected to erode initially. This erosion can be attributed to various factors, including the inherent challenges and costs associated with scaling up production, meeting stringent regulatory requirements, and navigating the complexities of a dynamic and competitive electric vehicle market. Despite these initial hurdles, Ford remains optimistic that the long-term benefits of increased production will ultimately contribute to achieving its profitability goals for the Model E segment. Significantly impact overall profitability. The initial higher costs associated with ramping up production and expanding manufacturing capabilities are acknowledged by Ford. However, as the company accelerates its scale and increases production volumes, it anticipates substantial improvements in efficiency and cost optimization. With the ramp-up in production, the per-unit cost of manually manufacturing electric vehicles is expected to decrease. This reduction in per-unit cost is a key factor in achieving improved profit margins. The benefits of scale extend across various facets of the manufacturing process, encompassing streamlined supply chains, negotiation of favorable supplier contracts, and attainment of higher levels of operational efficiency. Beyond the production scale, Ford emphasizes the critical importance of enhancing design and engineering efficiencies. By continually refining and improving the design and engineering processes for electric vehicles, the company aims to reduce production costs, enhance product quality, and achieve better profit margins. Lowering battery costs is identified as another crucial factor in Ford's pursuit of profitability in the electric vehicle segment. Batteries constitute a significant portion of the cost structure in electric vehicles, and any reduction in their cost can have a substantial impact on overall profitability. Ford's comprehensive strategy involves a multifaceted approach, encompassing production scale, design and engineering efficiencies, and targeted reductions in critical cost components like batteries, to achieve sustained profitability in the rapidly evolving electric vehicle market. The outlook for Ford's EV business hinges on its ability to effectively execute its ambitious plans and navigate the challenges inherent in the dynamic electric vehicle market. While Ford's strategic approach, encompassing production scale, design and engineering efficiencies, and targeted reductions in critical cost components like batteries, appears comprehensive, the ultimate success will depend on the company's ability to translate these plans into tangible results. The promise of decreasing battery costs over time, driven by advancements in battery technology and achieved economies of scale in production, is a key factor in enhancing the overall profitability of the Model E segment. However, the real test lies in Ford's execution of these strategies. Successfully navigating the complexities of the electric vehicle market requires not only technological innovation but also efficient supply chain management, robust operational execution, and the ability to adapt swiftly to market dynamics. While Ford's long-standing presence in the automotive industry provides a foundation, the success of its EV business depends on the company's agility in responding to the rapidly evolving landscape. The comments section below provides a space for diverse perspectives. Share your thoughts on whether you believe Ford can rescue its EV business and overcome the challenges it currently faces.